Well, we heard from Peter Cook just a few moments ago about the progress being made with a deadline for Congress to reach a deal on the deficit less than 2 weeks away. And it does appear as though the Obama administration may finally be prepared to accept a short-term increase in that debt ceiling if it's combined with a major agreement to cut the deficit. And we're going to find out right now whether the market believes there is any light at the end of the tunnel, because Carl Lantz is here. He's the head of U.S. interest rate strategy at Credit Suisse. Carl, welcome back to the show.
Good morning.
Is this, you can't help but feel as though this is going to be a buy the mystery, sell the history kind of a situation. Up until now, treasuries have been trading, at least the 10-years have been trading under 3%. Now that we have signs of a deal, they're beginning to back up a little bit. What's going on in the market? What does the market perceive here?
Well, the market's had so much to focus on, right? We've had the economy, we've had Europe, and we've had this going on. And I think the market's given Congress the benefit of the doubt. Who knows why? But they've allowed this to sort of fester. And now that we're in crunch time, now we're really focused on this every day. And we're seeing both sides bicker back and forth. And we are starting to get a little more nervous as it gets closer. The primary concern isn't really that we'll go past August 2nd. I think most people think that's off the table, and if we somehow did, nobody's going to miss a coupon or interest payment. The question really is, do they do anything credible, and will we get downgraded on the back of what they do?
Why is there any more concern about the credibility of a solution now than there was 2 weeks ago? Because what's being discussed today isn't substantively different from what's been on the table the last few weeks.
Right. Well, I think those of us who have followed Congress long enough know to ignore them by and large until they get close enough to a deadline. So, you know, the sort of rancor back and forth was to be expected. I think now we're getting, you know, it's getting a little uncomfortable here as the hours tick by. So now we're really looking for signs of progress. And the Gang of Six was this ray of light, perhaps. But it's not surprising that the reaction has been tepid at best from the House.
Carl, you were on the record with us back in May when the original deadline for the debt came up, saying, look, this is a great time to go long, especially on the short end of the curve. You can make money at a time when the U.S. Treasury Department is handcuffed, can't issue any net new debt. And that proved to be a great call. Are you thinking at this point that maybe you do the reverse? Now's the time to sell?
Yeah, I think you have to take your time a little bit because they'll be slow to bring back that issuance. So assuming they do raise the debt ceiling sort of August 1st, 2nd, sort of see something on the order of 25 to 50 billion a week in new bill issuance, which is a lot, but there's a lot of pent-up demand. A lot of pent-up demand. So you would see those rates slowly creep higher. That's right.
Okay, but now it's not as if now is the time to completely reverse your positions and bail out of the Treasury market wholesale.
No, I don't think that's right. But we do expect, you know, the treasuries in general to cheapen up. I think the 10-year point's going to cheapen up on the curve. If we do get a deal passed, I think it removes some of the uncertainty, so it could actually be risky assets that do the best. And the Treasury market, which, as you pointed out, hasn't exactly been selling off this whole time, you can see some money flow out of that into stocks, believe it or not.
Carl?
You told us about 15 minutes ago that you feel like we're not so worried about the market in particular, not so worried about hitting this August 2nd deadline. You're more worried, or the market is more worried, something credible is going to get done, and whether or not the U.S. faces a downgrade. What is an investor to do at this juncture?
It's tough. We've seen trading volumes decline quite a bit. Investors are sitting on the sidelines as they're waiting this one out. I think for now, in the Treasury market, we think you know, there's certain trades on the curve that make sense. I think the
Such
curve
as?
steepeners, you know, anything that reduces kind of our fiscal credibility on the margin should relate to a steeper curve. And I think it's unlikely.
So that risk to you that the U.S. does get a credit downgrade is real?
It is definitely real. I think the burden of evidence is now on the U.S. I think the rating agencies have a bit of an itchy trigger finger, and it's probably more likely than not right now that they would move.
Do you think they just want to make up for past faults of missing everything they missed in 2007, 2008?
Yeah, well, I think there's some of that, and there's some of it they've taken pressure from the Europeans who are getting downgraded, and they say, look, the U.S. looks just as bad on paper.
Carl, I want to jump in and ask you a question on that front. How much of the Treasury market's pretty strong performance over the past couple of months can be attributed to people looking at Europe and saying that situation is worse? And what happens if the Europeans, paradoxically, come to some sort of an agreement on Greece and actually put some kind of a fence around the sovereign debt crisis, and here in the United States, Congress doesn't come to some sort of an agreement that lends confidence to the long-term debt picture?
Well, as unlikely it is that Europe gets its act in order today, but I'll humor you for a second. That would be obviously the worst case for the dollar and for the Treasury markets, I think, is if we fail to have any sort of credible act, we fall back on a plan B or plan C, and Europe is finally now getting the joke and taking very proactive steps.
I mean, Carl, not to be self-aggrandizing, but I mean, the U.S. does have, at least in theory, consolidated political power, meaning even if Dems and Republicans are fighting it out on Capitol Hill, we're not trying to deal with 19 member states, all with different languages, no central bank. I mean, the U.S. is in a different situation than Europe.
No, I think people try to draw that parallel far too often. We have a consolidated country that's been around for 200 years. We have all the world's nuclear weapons, which, you know, is not for nothing when you want to be the reserve currency. So we do have the political might. We do have the power of the press. We have a lot of things going for our credit rating. It's kind of ours to lose.
It is, you say, as you put it, America's to lose. But is it not possible in the short run, I'm talking 1 month, several weeks, that signs of life in these European debt talks may suck some of the money that has flowed into the Treasury market out and back into some of those European names?
Yeah, I think that's right. I think foreign reserve managers in particular over the last several years have been looking to put more funds into Europe. And recently it's been more difficult to do that given all the chaos. And so it's back to Papa Treasury. And you could see a bit of that unwind on the margin.
Carl, you've been...
Things are coming to a head in Europe.
Yeah.
Does the focus need to be there right now?
Yeah, I think for right now the focus is definitely on Europe. As we go through the morning, I think we're going to get more and more statements out of there. Specifically, we need to see a real plan to finally ring-fence Greece. It looks like they're going to have to bite the bullet and do a debt exchange where they exchange bonds of lower maturity for 30-year maturity. This brings up the possibility of selected default.
Yeah, pretty
and the
hard
ECB,
for Moody's and S&P not to call that a default, right?
Right. So then you're going to have to
getting less money than you thought you would.
So you're going to have some sort of guarantee program. So I think some EU body is going to slap a guarantee on these bonds so the ECB can keep taking them as collateral. Otherwise, it'd put the Greek banks into crisis. And then more holistically, you have to come up with a plan for funding banks if there is more problems. So EFSF, having credit lines to the member states to fund the banks is one option. And then potentially having the EFS...
Issuing Euro-wide bonds.
Issuing Euro bonds doesn't seem on the table. I think that's where we need to ultimately get to. I'd love to see that. And at least in the immediate future, have EFSF purchases of bonds in the secondary market to come in and buy those Italian bonds as they push above 6%.
Because we still have really no details, and it's Italy and Spain that basically begged Merkel to even do this summit. She didn't even want to go.
Yes. It's been the Germans dragging their feet, and you can see why. Their internal politics aren't such that everybody's jumping up and down saying,
also, they probably
bail out
don't want
everybody.
their taxpayers to be on the line for Greek debt, which is one possibility.
Right. So we look at how difficult it is to get anything done in the U.S. and the polling here. Just imagine if you're being asked to bail out another country.
It's
Well
some
said.
pretty hard imagining to do. Carl, thanks for being here. Carl Lantz, Head of Interest Rate Strategy at Credit Suisse.